How's everyone going this week? We got Doug join us. Thanks for. There he is. Now he can hear us talking about him. How's it going, Doug?
Yeah, no, I know people are talking about me anyway, so all
We're
good.
live.
Hello, I'm
We're live.
back.
I wanted to start without you.
That's fair enough. No, people are here for you anyway, Kirk.
No, they're not. Well, good. So we're currently live, and thanks for everyone joining us this week live. We are also going to. This will be in the replay. And we have a special guest joining us in about 5 minutes, which will be really exciting. It's exciting for me because I haven't talked to him in the last 2 years, and this guy travels the world. So if you really want to know what's going on in inflation, don't listen to me. Listen to this guy. This guy is a wealth of knowledge. So we'll get into that in a minute, but we'll get started here. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today, I'm once again joined with my good friend Doug Hagren. Hey, Doug.
Easy for you to say, Kirk. Good morning to you.
I got to take the marbles out of my mouth, apparently. So yeah, Doug, what's going on this week? What are you seeing in the world?
Well, I was talking to Henny Penny, and he was telling me that the sky is falling. If anybody has ever seen Chicken Little, that's a little bit of a pop culture reference there. No, I mean, race. Be honest with you, what I'm seeing recently, Kirk, is that we've had we had a little interesting little pause in some of the chaos there. We had some market kind of pull back and sort of rebound a little bit. Up leading up to the words from the Fed the other day, and then things pull back a little bit more. But what's interesting is, other than that kind of initial shock, it seems like when the Fed speaks now, it's having a little less. It's having a little less of a shock factor on the listeners, because it really seems like, as has happened several times after the Fed has spoken, there is this little bit of a pause that kind of comes in and says, okay, we're not really gonna fear that too much. And I think it's because I'm not a big fan, Kirk, of saying it's priced in, right? Because I think that every time I hear it's priced in, nobody really believes it till it happens. But I think some of the crazy's priced a little bit, and and a lot of people knew pretty candidly that the Fed was going to come out and raise rates again. And so it wasn't all that unexpected. I know that the mortgage rates popped over 7%. They pulled back a little bit, back under 7%. So mortgages are cheap again. Kirk, how do you feel about that?
I have to tell you, I'm not thrilled, but thank you for thinking of me, Doug. They are. I don't consider them cheap, but hey, if the Fed came out and didn't surprise anybody, but yet somehow the market reacted negatively. I think that was probably baked in. But look, I find it funny because we raised 75 basis points once again, which we've been talking about this show for the last year. It's going to keep happening. I know people think that all of a sudden January is going to roll around and the Fed's going to start easing. I don't know what planet you're on, but I want to come visit because it sounds like a lot of fun. This is not going to stop. And we have a special guest we can bring on in about 5 minutes, and he's going to talk about what's going on outside the U.S. Yes, believe it or not, there's actually at least one country. I don't know how many, but at least one country outside the U.S. I said it here. You heard it here first. I know no one else is saying this, but you heard it here first. So we're going to bring him on to talk about what's going on in the world of inflation. And you can hear it firsthand. This guy travels everywhere. So one thing I did want to touch on, because I thought it was hilarious. I got an email earlier this week, or I guess it was after the Fed speak, and people were commenting on how talking about the NASDAQ and how the NASDAQ is the market. And I started laughing when I read this because it's so true. It said, when you look at the NASDAQ as the market, it's not the market. It's technology or technology related. You want to hear the makeup of the NASDAQ? So the S&P is generally widely accepted as a diverse index of different indices. Let's look at the NASDAQ for a minute here. The NASDAQ has 0% weighting in financials, 0. It has 0% in energy, 0% in materials, and 0% in real estate. Well, I think that's about half the S&P 500. So all of those happen to be value sectors. So if you want to know how the NASDAQ is doing, we talk about this in the show. Technology is not the place to be right now. If you're buying the dip, you might keep buying for quite some time. It may keep dipping. So if you're looking at the NASDAQ as an index, you might want to look somewhere else. So I want to dive right in and invite my good friend Mikkel Thorup onto the show. He's been on the show before. If you haven't heard his episode, I will put it in the show notes. He has a wealth of knowledge. Welcome, Mikkel, to our
Thank you
fourth
very much, Kurt.
LinkedIn Live episode.
Well, I'm excited to be here, and it's good to talk to you again. Yeah, I think it's been, I want to say, about 18 months since last time you and I were on the phone. Because I remember I was in Brazil, and my son was just born, and I remember sitting outside having it was a beautiful day, and you and I were on the phone for catching up for about an hour or two. So it's good to chat with you again today.
Yeah, and congratulations, my friend. Congrats on your son, and hopefully he's having a good time, and you are too.
Yeah, absolutely. Happy and healthy.
So, where in the world is Mikkel right now? Where are you living, or at least residing at the moment?
Well, today I'm in Panama, Panama City, Panama. We have a home here. We've got homes in a couple different countries. We spend time in multiple countries every single year, but I'm in Panama City, Panama right now, and it's a beautiful day here. And yeah, hot and humid, but beautiful.
Nice. So I wanted to ask you, and the reason I want to have you come on the show, I know you're doing a online summit coming up in the next week or two, which I'm really excited about. You've got some great guests, but what are you seeing? Like inflation in the U.S. started last year, around mid-year, and people just kind of said, "Oh, it's transient. It's going to go away," and of course, it didn't. But we live in U.S. centric viewpoint of the world. Like there was nothing outside of the US, but the whole world has inflation too. So what are you seeing in, like what are you seeing in different parts of the world, and how are people reacting to it?
Yeah, so it's interesting because you have to understand that the US is exporting a lot of the inflation to the other countries. They're printing dollars and they're shipping paper across the world, and the rest of the world is shipping goods to the US. But at some point, that's going to reverse. At some point, they're going to get to understand what's happening in the game, and they're going to stop a lot of these types of things. Now, recently, I was just in Argentina. I was in Buenos Aires a few weeks ago, and it was amazing to sit down with my friends and with my lawyer there and some of my colleagues and start to hear about what life is like there under such an inflationary period. I mean, they have over 100% annually right now. They actually have 5 different exchange rates, which is so wild to go through. So you can go to the bank and get one rate. You use your credit card as another rate. You go to an official money changer, it's a third rate. You go to an unofficial money changer, it's a fourth different rate. And it is a very bizarre experience. The velocity of money is so fast. People cannot save. They cannot hold on to anything. They even have capital controls on how much US dollars someone can own or how much a percentage of their money that they can transfer into foreign currencies. So this is a very bizarre type of experience right now. Now, Argentina itself is not unaccustomed to inflation. They've gone back and forth 101 times. I think the country's been bankrupt 21 or 22 times over the last 120 years. So they've seen these types of things, but it's the resiliency of the people, which I find so interesting, how they deal with this. They understand that the government is not there to be their friends. It is not there to help them. The government is the problem. It is not the solution. So looking at these types of countries, I think is a real model for the US. And if people can start to understand what's happening in foreign countries, then it can really educate them what's happening in the US right now. Does that make sense?
Oh, it makes total sense. I've heard all the stories about Argentina and how people have it. They figure every few years that their currency is going to be worthless, and some of them live on the border and they go across border with their banking, and they've just found ways to manage the system. What scares me though, Mikkel, is in the U.S. we've never seen that. Countries like Argentina they're accustomed to it. It's just a way of doing business. It's like the Greeks, right? The Greeks have also their currency has been worthless, or they've defaulted on their currency. To be clear, what, like 3 or 4 times, at least. So people like that are accustomed to it, and they built it into their culture, into their economics. But we haven't seen that. So I mean, what do you think is going to happen here, given that some of these other countries will probably be fine, and we don't know how to operate.
Well, I think that people are going to get a rude awakening. There's no question about that. If we look at the value of the dollar over the last, say, 100 years or so, it's lost what, 93% of its value? That is absolutely on a like unbelievable. And this is supposed to be the world's reserve currency. I figure that there has to be some type of shift at some point. When it exactly will happen, I'm not sure. But I think that we still need to go back to some type of commodity backed currency or gold backed currency or something like this. And this is certainly what we're seeing as Russia and China are getting off of the petrodollar, as they're transacting with one another. They obviously don't trust each other or their paper currencies. So they're been stockpiling precious metals for a very, very long time. And they're trading natural gas and oil and commodities and wheat and things like this in precious metals, and they're settling on their own. And I think more countries are going to wise up to what's happening, and it's going to change. So there has to be some type of big shift, because we can't just keep kicking the can down the road. It's just not possible forever and ever and ever. But yeah, as you visit foreign countries and you see how they're dealing with these types of things, it's going to be, how to say this politely.
You don't have to be polite on this show, Mikkel.
Okay, well,
Not going to
I
start
think that
now.
there's going to be a lot of heartache. Honestly, I think that there's just going to be a lot of despair. I think people are going to be going bankrupt. I think they're going to lose everything that they have. And I know that I'm not painting a very rosy picture here by any stretch of the imagination, but people need to be woken up to a little bit of this. I think that having tangible assets, investing in real businesses that produce real tangible things like real estate or agricultural land or timber, even things like Bitcoin, which they can't turn the printing press on, or technically Bitcoin has inflation, but we know exactly how much inflation it is based onto 22 million coins. So, everything like that, you can understand. But as they're printing trillions of dollars and sending hundreds of billions of dollars to Ukraine for military aid, like, this has just got to stop. It absolutely has to stop.
So, because you have a lot of experience as a global traveler, are there countries that you would say, if you had to go somewhere? Because I was thinking about this, you and I have talked about this a lot. I was thinking about what countries would I go to? And top of the list were Canada and Australia, because they're most similar to the US until COVID hit. And then I realized those are probably the last places I want to go. So, right now I have no countries on my list, or maybe even Mexico, which, maybe it's safer with the gangs than it is with the government. But where would you go if you had to find, or like a handful of countries, you'd say, if I had to go somewhere, these would probably be the better ones?
Sure. So there's different ways to look at this, and kind of what you're trying to achieve here. If it's just strictly inflation, then I would be looking at countries like the Cayman Islands or Switzerland. I mean, they have inflation, but not at the same rampant levels. If you're like, I specifically work in tax-free zones or offshore markets or tax haven type of countries. So I really like countries that follow what's called a territorial tax system, basically meaning if the income is derived outside of the country, it's called foreign sourced income, and they don't tax you inside the country. So I'd be looking at countries like Belize, Costa Rica, Nicaragua, Panama, where I live. All of these countries can be set up to be tax free. Now, if you're a US citizen, you're still going to have obligations, but there's tools in the toolbox to legally reduce your taxes. I like other countries as well who are very food independent, who are water independent. Like, I was just in Uruguay. I've been in Uruguay twice this year. We're looking at doing about a 7-figure investment there for my family. And they have massive amounts of agricultural land. So the country is 3.5 million people. They produce enough food to feed 40 million people. Like, that's a country I want to be in. They produce massive amounts of timber that's used for pulp, for paper. These are massive exporting. The country still has inflation, but all large transactions are done in US dollars, and they have real commodities to back a lot of these things. So these are some of the countries that I'm looking at or working on with my private clients at expatmoney.com.
Great. Well, I appreciate that wisdom, Mikkel, and just have kind of one more question for you, and then we'll let you go here in the interest of time. I know you're a busy guy, and you've got that summit coming up. What can people be doing here? Because obviously, investing or moving internationally is an option. Although I think for most people, it's inconvenient because that's not how we're wired, myself included. Like, I don't want to pick up and leave unless I have to. If I have to, I'll do it. We did that during the pandemic. We rented a house down the beach for like 3 months just to get out of the city. And I'm willing to do it in this interest of saving my family if things like this happen. However, most people are stuck in our system or social circles, and it's hard to do. So, how would somebody protect themselves while still sticking around in the US, assuming that the problem is not entirely global?
Yeah, sure. So you can take the clients that I work with kind of in two buckets. The first bucket is the people who are done. They're done with the US, they're done with Canada, done with Great Britain, and they're leaving. They're moving overseas. That's probably about 50% of the people that I work with. The other 50% are the people who understand that they need to have a plan B, they need a backup plan, they need to have foreign accounts and bank accounts and real estate and a residency or a citizenship in a foreign country. Now, they still reside in the US or Canada or wherever home is. That doesn't change. But what it allows them to do is sleep a lot sounder at night because they understand that if something happens and, shit hits the fan and they need to go, then there's a place where they can go that will welcome them. So those are a lot of the things that I work with my clients on, having these plan Bs set up, all of these tax mitigation and structuring types of options. You can kind of think of it like political insurance, but like any insurance, Kirk, you have to have it in place before something bad happens. So you can't get auto insurance the day after you get T-boned or fire insurance the day after your house burns down. You need these things in place first. And for
You mean
most of my clients,
strapping your seatbelt on while you're flying through the windshield is not a good plan?
well, you could try, but I'm just not sure.
If you're very, very fast.
Exactly. So I think that having these things in place in advance is the name of the game. And that's really what we're doing. We're talking, we're trying to educate people, we're trying to get people up to speed as fast as possible. So as you mentioned, we're doing an online summit. It's happening right now, starting on Monday as this goes live on Wednesday. Then we'll be a couple of days in, but you guys can grab a free ticket. There's no charge to attend the summit. If you guys go to expatmoneysummit.com, you can grab a free ticket. We have Jim Rogers is going to be a speaker at the online summit. My friend Doug Casey is a speaker. Dr. Ron Paul is a speaker. And then lots of the lawyers and accountants and CPAs and service providers that I work with my private clients are all going to be speakers there as well. So even if you're not sure if this is for you, if you just want to dip your toe in the water and try to understand a little bit more, then you can go to expatmoneysummit.com. You can grab a free ticket and learn more. I'm happy to help your audience and try to look after all the people at the Money Tree podcast.
Great. Well, once again, Mikkel, I appreciate you coming on the show. And that's expatmoneysummit.com. We'll put that in the show notes. Certainly for the live audience, you can put that in the comments there. But always enjoy our conversations, my friend. We have to catch up soon once you're through the busy season with all your summits. But I unfortunately I will be traveling during that time. But I never give up an opportunity to listen to Jim Rogers. He is a wealth of wisdom, and I know you've got a ton of people also on your list that are showing up, that many of which I've had on the show. They're just unbelievably smart people. So good luck, my friend. Stay safe, and happy travels.
Amazing. Thanks so much for the opportunity, and talk to you guys soon. Thanks, Doug. Appreciate your time. Bye-bye.
All right. Bye.
Nice meeting you.
All right. Well, always love having Mikkel on the show. We'll probably have to get him on again. It's just kind of one of those things. I'm actually speaking at a conference in a few weeks about similar topics. And I know many of you, the listeners who are in the Insiders Club of the Money Tree Investing podcast, will get invites to that. If you're not an Insiders Club member, please go to moneytreepodcast.com. And there's plenty of places. There's actually a pop-up that'll show up that will give you an invite to the Insiders Club. And you can get invites sent there. So, Doug, let's get back to business here. We've got plenty to discuss. So what's next in your list? I know you just sent me a bunch of charts I haven't had a chance to look at. But
yeah, I'm always doing that, right? And so, you know what? I'm going to just take a quick pause here because, as he's talking about inflation and what's going on in the world, it started to make me think about, a lot of things that people bring up is kind of what happened to the Roman Empire, right? And the Roman Empire was, one of the things that they say kind of undid the Roman Empire, of course, beyond probably getting outside of its manageable geographic parameters, was inflation. And a lot of that inflation started under Diocletian. One of the Christian fathers, St. Gregory Nazianzus, those names are always easy to say, commented on one of the biggest causes of inflation And I think it's really important to see this because people, we've talked about this before, right? Just printing money does not create inflation. If it did, we'd had inflation back in 2007. We've been printing money forever. What creates inflation is that when there's too much money, not enough goods to get to buy. But one of the things that they also discovered is that one of the main causes of inflation is, and what he, and what Gregory Nazianza said is, war is the mother of inflation, and that's a critical thing to keep in mind. It's also, it's the mother of, I'm sorry, it's the mother of taxes, and it's also the mother of inflation. The consequence of inflation, basically, that is the reduction of freedom of the people. So as you start to get into a situation where inflation rapidly increases, it erodes the ability of individuals to live through economic freedom. They can no longer form it. I mean, Rome had a laissez-faire concept of state economy relations. And ultimately, as there was pressure to pay troops, as there was free trade, ultimately Diocletian put the first price caps on things, which have worked so often, right, Kirk? I mean,
yeah.
there's a lot to learn from history. And as these things, the biggest issue that came from this was that when it destroyed the freedom of the Roman people, their economic freedom, and when that happened, it ultimately created pressures that allowed the outsiders to start basically creeping in and undermining the Roman regime, because now the Roman regime, with a lot of its economic policy, became the enemy. And we've seen this before. People, when you look at the Arab Spring, right? Arab Springs have always coincided with food and lack of food. The fall of Libya had to do with, all of a sudden, people couldn't get fed. And a lot of that has to do with inflation and economic freedom. And I think this is a critical component that we have to look at when we're listening to some of the things he's talking about. I think there's pros and cons and arguments. He's obviously in the business of helping people become expats and invest and live outside the United States. But outside the United States, there's a ton of problems too. I mean, you look at some of these tax shelters and tax havens like Puerto Rico. I mean, they can't even keep regular electricity and water flowing. So, I mean, you've got to be able to understand that those things don't. I mean, it was right after like Iraq, right? Iraq was going to be an incredible place to invest, and for years following the fall of Iraq, it was like, well, you should be putting your money there. It's a tax haven. It's going to be, we're going to get hundreds of percent growth. That doesn't necessarily happen. So I think there's some speculative reasons, things to think about. I think it's good to be diversified, but I also think that just as much as we've got problems, holy moly, Kirk, the rest of the world's got bigger ones. So, I
Yeah, I
mean,
agree with that.
that's something to think about. So,
and it's funny. It's a nice segue into those of you who are listening to us live on LinkedIn, which we're doing these episodes live on LinkedIn every Friday, usually around 1 o'clock. So if you're not on those, if you're interested in getting on those, if you want to get if you want to send in questions, we're happy to answer them. But oddly enough, this Friday we have a episode that just was released with Lee Gehring. About the future of food and agriculture. And he's probably one of the foremost experts in the industry when it comes to that area. And I have to say, I love the interview. There's so many good takeaways from that interview. I'm going to have to listen to it over and over again because I took copious notes. And I think if you really want to know where the next 10 or 20 years are going, you really need to understand what he's talking about. Obviously, nobody knows the future, so don't take my word for it, but do your own research and do your own thinking too. We do have an election coming up next week, and I saw my LinkedIn post this week. I got a lot of love and hate on it, but you got to do your own thinking. We're going to release another one along that lines, but it doesn't matter who you vote for. Just make sure it's your thought and not somebody else's given to you. So that mental framework is what you need to carry with you for investing. So I try not to bring politics into the show because it's not where I want to go with things. I try to keep this with investing, but you can use that similar mindset, right? You think about, and I'm going to use politics as a framework on how to think about things. And I'll probably piss everybody off listening to this and everyone will probably leave, but I don't care because I'm doing this for everyone's benefit, not my own. So if you think about it, think of two parties, right? You have one party who believes in one thing. You have one party who believes in something else. Are they right? I don't know. Who am I to judge, right? On one side, you have a bunch of people that say, "Well, I'm right," and the other side is stupid, evil, or uninformed. You know what the other side's saying about them? The exact same thing: stupid, evil, and uninformed. So you have two people looking at the same problem, coming up with different solutions, and they both hate each other. And you know what the funny thing is? They both want the same thing. The only difference is they have a different perspective on how to solve the problem. They still understand the problem. Okay, they still see, hey, this is a problem. Homelessness, it's a problem. People don't have enough food to eat. It's a problem. They just disagree on how to solve it. And I think what all of us need to come together, because even though there's divisiveness and mudslinging and all the garbage that goes on around elections, all of us need to come together and realize that all of us want the same thing. We just disagree on how to do it. And if we realize that that is really the issue, then we don't need to be divisive, because we want the same thing. And try one thing, try another. But anyway, we don't go down that road. The point is you have these two frameworks, right, on how to look at the world. And, what you should realize is your framework is not the only one. So everything you do when it comes to investing, all your assumptions, all your mental models, all your investing thesis, they're all an assumption. It's not a fact. And we'll talk about this next week, because maybe we'll talk about this week. But I'm going to go into a bunch of investing half truths throughout the next few shows, because I think each one is something you probably assume is true. We talked about this in the title about your investing style is dangerous. All right, here's two of them. First one: buy and hold is a good idea. That's a half truth. You're probably thinking to yourself, you're an idiot. Of course, buy and hold is a good idea. Warren Buffett says it. Vanguard's been telling me that for years. Everyone says buy and hold is a good idea. Yeah, is it? Well, it's a half truth, because it sounds intellectually true, right? Mostly it's true, but it's not true 100% of the time. Okay, and here's why. For the last 40 years, inflation has dropped, interest rates have dropped, which has allowed the economy and the markets to create enormous amount of wealth. Okay, so we've had the wind at our back for 40 years. Now we don't. Okay, so buy and hold is a good idea during bull markets, because it keeps you in the market and keeps you from getting in trouble. The caveat that is never put into that buy and hold is the best strategy is that it's not always the best strategy. It's not a good idea in bear markets. It's not a good idea. Take for instance, January of 2000 to July of 2013. Was it a good idea to buy and hold? Sure, if you wanted to waste 13 years of your life not compounding your money, it's a great idea. But that's basically what happened. You lost 13 years of compounding. So really wasn't a good idea, right? Now, let's take what happened this year. Is it a good idea to buy and hold? I don't know. Pretty much whatever you held went down 20 or 30%, so probably not. And I can't predict the future, but my thesis is that I think that not every year is going to look like this year, but I think we're going to mirror the 70s in a lot of ways, which is a lot of volatility, much like the early 2000s, early to mid 2000s. So I think if I'm using that as a framework, then buy and hold is not a great idea, right? It's a good idea sometimes when conditions permit. But if you're going on the assumption that is always a good idea, then you're going to stop thinking. Okay. What we try to get you to do in the show is to think. I don't want to regurgitate all these different phrases and smart things that people have said over time. And you say, oh, that sounds really smart. I should do that. No, I want you to think for yourself. I want you to get up in the morning and say, does this make sense to me? Where is this going wrong? Because there is no truth in the financial markets. There's just a different perspective that may be right or may be wrong. And the only way you find out is by looking at the history of it and saying, oh, yeah, I was right or I was wrong. But we can't predict the future. So we're trying to get you to think smarter and think more intelligently about different mental frameworks so you can be more successful. If you have the right thinking around investing, that is really the pathway to success. There's nothing I can say that is going to help you be a successful investor, except to get you to think for yourself and to analyze what is the best thing for me. So, Doug, I went in a little rant here. I love this topic. So, what do you think? Is
Well,
buy and hold a good idea?
I think, it definitely depends on, to a degree on macro and micro focus too. I mean, I don't know about you, but I bought my Pitney Bowes stock, back in, 1998, and it was a good, like, $56 a share, paying a nice 5.9% dividend. It's now worth about $3. And you know what? But I'm going to buy and hold that because I know stamp machines are coming back, Kirk. They're coming back, and I'm
Yeah.
not going to take a loss on this thing. I'm going to keep holding Pitney Bowes. I'm just like, I could wipe my what with Woolworths. I mean, I mean, I think that there's a lot of factors go into this, right? If you need money in some time in the next 20 years, okay, then you have to really you really have to be conscientious about what buy and hold may actually mean to you, because time is money. If you lose money, and this is what people think, it's like, well, the market's down and it's going to come back. Well, if you lose 50% in the market, and let's say you said you have an incredible run in the market coming out of that, 10 to, they'll just keep it simple, 10% per year from that. You're like feeling really good because 10% sounds great. Everybody I mean, it keeps it easier than rounding Dave Ramsey's 12, but we do 10, right? And you went from 100 to 50, you're going to get a nice 10% a year. Well, when you do the math on that, that's $5. That's only $5 a year. So how long does it take at 10% for you to get back? Well, it's going to take you 10 years to get back to 100 at that rate. Now, I know the math's a little off with compounding, but the fact is you just lost 10 years to get back to where you were. But then that's where a mistake comes in. People think, well, I got back to whole, so I didn't lose money. This is the reality of money. You cannot get back money that you lose unless you not only put back the money you lost, but you put back all the money you would have earned with it. So if it was at 100 and it was growing at 5% a year, or let's just say 10%, or let's keep it at 5% average to keep it conservative, at 5% a year on simple, over that 10-year period, you would have earned another 50. You would have been at 150 instead of 100. But now 10 years later, you're back to 100 and you think you're whole. You're not whole. There's massive opportunity cost to losses. And so every time you lose money and you lose time, the only way you ever make yourself whole is to go back and be able to put not only the money you lost, but the interest you lost with it. And now if you're in a time frame where you're moving into a distribution phase from an accumulation phase, and the great mistake, Kirk, that people make is they all think like accumulators. Like, I got plenty of time. I got plenty of money. I'll earn it. It'll come back. I want you to visualize right now that your money is like a plumbing system. Okay. The biggest tank is going to be the money that you're going to earn. It's your future income. Okay. And we make decisions every day based on the fact that that pipeline is going to keep dripping money in, because we don't get it all at once. We got it all at once, we would sit there and think money is finite, but we don't. We get it systematically, a little bit at a time, a little bit at a time, a little bit at a time. And you know what? If you go out and spend a little more than you need to, or take a little losses, don't worry. There's more money coming in and you can buy the dip. Well,
Yeah.
I want you to imagine for a second that tank disappears. It's not there anymore. And now all you have are the tanks you had that you've already filled. And now you're living off that. It's a different mentality. And it's a psychology that most people do not understand, that distribution is much more critical than accumulation. And that is why there is always a cost to losing money, because there is not necessarily a time frame that you can get it back and put back all you would have earned. And also, if you are spending that money when you no longer have that income from those tanks, or you're going to be doing that sooner than later, then there's a real critical analysis that has to be made on exactly how big the impact of those losses are. I'm not a fan of buy and hold. I think that you have to have help on this. I certainly don't think you chase the markets. But I do think that you have to really look at the tea leaves and have some sort of a concept of what's going on and position yourself to be in the best place you can for those conditions, because ultimately times change, investments change, some things never come back, and those that do, they can cost you a lot of money in just waiting for that time to come.
Yeah. Yeah, it's personally, I want those tanks to be filled with oil or gas. I'm not sure if I'm not sure if you have any extras of those. Would have liked to have bought that a few years ago. So look, and I think Doug's right, and we're going to be talking about retirement issues at some point in time in the future. For those of you who listen to us every week, I apologize for beating the dead horse about inflation every week, but I do it because when I was like about a year and a half ago, I sat down and thought, like, we started to see, it was about a year ago. Yeah, about a year and a quarter. And when inflation started to pick up, right, midsummer of 2021, and inflation started to pick up, it was like 8% plus. I was like, all right, that's not normal. I mean, you could pass it off. Maybe it's an odd error. Nobody knew at the time. But I started to think, like, if this is the beginning of what we've thought was going to happen for quite some time, how do we deal with it? And it literally took me 6 months to wrap my head around it. Like, with my knowledge and understanding and knowing that something like this could happen, but you don't really know. Like, you don't know the future, right? I don't know what's going to happen. I have a sense of where it's going to go, but I don't know, right? Nobody knows, right? You just have to have your own theories, and hopefully you have your framework on investing in the world is better than most, so you can help navigate it. But when you think about it, there's there's a lot of challenges ahead of us, and I don't know what all of them are going to be. So I took my time to really think through this in a way so that I could easily explain it to my listeners, to my clients, and to anybody who's really interested. And what I realized early on was this concept is too big. It's too big. It's like what Mikkel talked about earlier in the show, right? If you're from Argentina, you've experienced this stuff before. You've seen it time and time and time again. So you know how to handle hyperinflation, defaulting on the debt and the currency, all of that. You get it. It's part of life. We've never seen it.
Kirk, I'm
So,
going to add on to that because I've got Argentinian clients, and that's exactly their mentality. They're just like,
yeah,
yeah, we're just used to it, which, which of course, half of this battle is emotional competence, right? It's being able to manage getting through it emotionally as well as fiscally.
right. It's about having an agile mindset. It's about not being fixed, fixed first growth mindset. It's about having agile thinking, knowing that the future is going to be different. And most of us get very comfortable with the future being like the past. We just say, oh, I know when I get up tomorrow, I'm going to be able to go to work and I'll have a job. My kids go to school, I'll be able to drive. And then what happens if one of those days, one of those things is not true? You don't have a job, your car doesn't work, whatever. That screws with your head, right? Because you're not accustomed to it. You have these habits, and you don't believe me. Here's an example. How many times have you driven to work? Well, a few years ago when we were all driving to work. But how many times do you drive to work and then you got there and you're like, how'd I get here? I don't remember what happened in the last half hour. Did I drive? Like, you totally, like, your brain just shut off and you're just kind of like zoned out and you're following the path you've done 100 times before. That's because you have a habit. You built that habit over time. And so your brain just operates and doesn't have to operate actively in order to get there because you've done it so much. So it's the same thing with anything new. This concept is so big that the first time I explained it to people, they were like, oh yeah, it'll be fine. Then the Fed will bail us out. Like, no, that's not the math. That's not how it works. Like, yes, that is how it's worked in the last 20 years, but it's not going to work now because they can't. Inflation is the one thing that they can't make go away like magic by printing money. That makes it worse. So they have to ride this out, which means things get worse. So I bring this up because if some of this is over your head, it's okay. I do this for a living, and it took me 6 months to wrap my head around it, to really fully understand it. I don't expect people to listen to an hour podcast and be like, "Oh, I get it." It's just it's more complex than that. So this is why we beat the dead horse every week over and over from different angles to help you understand why it's happening, where it's happening, what you can do to protect yourself and your wealth and your family from what we expect is probably going to happen. And frankly, if it doesn't happen, then everything's going to be okay and you have nothing to worry about. But you're planning for the worst case scenario, so anything else is better. That's why we do this. And that's why Doug's on here with me every week talking about this, because he's always concerned about his clients. He wants to make sure everybody is safe and protected from what is to come, as I am. And, that's why you're listening to this show, because you understand the problems yourself. You're seeing it. You're seeing all the money printed. You're seeing it wasted on stupid government projects that don't go anywhere. You're seeing, I mean, look at COVID. I mean, that was a disaster of policy. But the economics and look at inflation. It's 8%. Hasn't hit 8% in God, how long? It must have been the 90s. It's been a while. So just understand that we're doing this because everybody needs to understand this framework if you're going to prepare. And as Doug said, mental preparation is an enormous part of this. You need to be mentally prepared for the fact that this is going to happen. So when it is, now you have a game plan, right? I just was reading. So we're going to have Annie Duke on the show in a few weeks. Awesome author. If you haven't read her books, phenomenal work. I loved her last one, Thinking in Bets. She just has a new one called Quit. And I was just reading the first chapter last night, and she talks about how people climbing a summit of Mount Everest, they had this process in place. They had 3 rules, and the second rule was, well, the first rule was have a time frame. We have to turn back by 1:00, right? Like that's hard and fast. No matter what happens, we're turning back by 1 because we could die and things get dangerous, right? The second one is to mentally prepare ahead of time for the fact that you're going to be turning around at 1. Because if somebody just says, oh, 1:00, time to turn back, you're like, no, I can see the summit. I got to hit it. And that's when accidents happen. So it's like you have to mentally prepare ahead of time and say, I'm going to quit at 1:00 because if I don't, I'm probably going to die. Like this isn't the markets. This is Mount Everest, right? Where a lot of people die. So the mental preparation allows you to say, okay, all right, I'm going to turn back. We did what we could. And now we got to go. Okay. That's just the way it is. So that type of thing, I think, is a little more extreme, but it illustrates the idea that we need to mentally prepare for hard things. If you're mentally prepared, they're not as hard, right? If you're not prepared, your brain shuts down. You don't know what to do, right? You think about soldiers, the first thing they're taught is they're trained under harsh conditions so that when harsh conditions happen, they just react. Like they do it over and over and over again, and they just react. They don't think because who the hell wants to climb a hill in the middle of gunfire? Your brain's not going to let you do that unless you've trained for it and you're trained to just react instead of think. So what we're trying to do is the opposite. You're reacting. We're trying to get you to think. So we're de-engineering what the Army does to the recruits. We're saying you need to think. You need to open your mind to the fact that all of these things are different. This is the one headline we say over and over. Everything you think you know about investing is now wrong. And over the next few weeks, we're going to talk about a lot of those. But buy and hold is the first one. We've got many more to come. But, what are your thoughts, Doug? I mean, we've got a lot to talk about today.
Well, yeah, no, I think you mentioned, I like what you said about the soldiers, and that's exactly why they're, the Navy SEALs go through such incredible training. And that's why 90% of them burn out along the way, is because they only want the ones at the end that are able to push through those greatest conditions. And this is a good life lesson for anybody that's out there. They have proven this. It's not only having been trained in how to handle adverse situations, but it's also how to get help in adverse situations. Is you have to be very direct in what you need and who you're asking to help. In situations of emergencies where someone has been attacked, beaten, injured, whatever, and they'll yell to the crowd, help me. Everybody in the crowd looks around like, who's going to help? I don't know what to do. Right? What do they teach you? The first thing in this, if you're listening to this, if you're ever in that situation, I don't care who you're looking for, you point to one person and say, you help me. Because if there is, once they get that accountability that you're talking to them, then they know they have to react and they will not look at other people. Hey, this is a survival thing. And so again, part of this is in the military, they're not, you get in these situations, they're not looking around saying who's going to help. I've been trained to deal with this. You need to be the person that is the professional that knows how to deal with this. And again, strap the seat belts on before you go through the windshield. And maybe you never go through the windshield. Again, just because you have never been in a severe car accident, does that mean that you don't need a seatbelt or airbags? That was a stupid addition and a costly addition to your car? Absolutely not. Because it gives you the peace of mind that if you never get in the wreck, you're still going to be okay. And yeah, you paid a little bit more money for it. And you're going to, you maybe lost a little upside. If I go back to investing, we chase returns so heavily. Again, going back to accumulators versus distribution, if you're thinking of accumulation, how many times do people have conversations, Kirk? And you see this. Well, the market's getting this. Why am I not getting that? Okay. Or the market's lost this. Why have I lost too much? Nobody's ever happy because they think in terms of return. Listen, sometimes I got this earlier this year. The market had gone down 20%. A client asked me, I know we don't make any money on cash. We've been trained to never have cash. When are we going to invest that money? Like, why is it sitting there? We're losing money. And I'm looking at I'm like, losing money? That cash you just had saved you 20% year to date on the money that was in cash. Cash is an asset class. And yes, okay, maybe the market runs in June and takes off and you sit there and go, well, why didn't I make any money on that? But if you look at the long-term scheme of macroeconomic impact, having a little bit of caution, having a seatbelt, having a little cash or other types of assets at times they might cost you some upside under current conditions, but it's okay giving up a little bit of upside if you are going to have a lot of upside in the long-term future because of a more consistent, diversified plan. And listen, I've said this before on different podcasts. I know we're going live, so probably a lot of people haven't heard me. If you don't, and this is something I can't remember where I got it. I know Michael Guyad, so I want to give credit where it's due, has said this. If you don't hate something about what you're holding, you're not diversified, right?
I love
Because
that.
that thing probably sucks right now so that it doesn't suck when things change. Okay. Unfortunately, too many people, Kirk, you know it. You know the Reddit. Well, just buy the S&P 500. You're the biggest area of loss you're going to have is those fees you pay. And listen, I'm not talking about astronomical fees for no reason. If you can get the S&P 500 for 20 basis points versus 100 basis points, you're stupid paying 100 basis points for an index, right?
Yep.
But if you're like, well, I do everything myself because I can go to Vanguard and I can just buy the S&P 500 because there's plenty of talking heads who will tell you every single day. Okay, I'm not going to say the names. That'll say all you should do is go out and buy Vanguard because I don't want to tick off friends of yours, Kirk, that people that come on this show. But they'll say the only way to be wealthy is to buy low-cost index funds and just buy and hold and buy and hold and buy the dip and buy the dip and buy the dip. Okay? Listen, the war between passive management, active management. Well, it looks really good when we've had 15 years, essentially, or 17 years of low interest rates, free cash flow, massive investment in tech. I want to go back to what you said in the beginning, Kirk, about the NASDAQ being, an indicator of a managed of a proper portfolio, and it's not the S&P 500. I'd argue that it kind of is, because if you take a look at what the S&P 500 was built of and how the S&P 500 performance is calculated, it's calculated by the greatest momentum stocks that are within it. So if you think that holding the S&P 500 means you're diversified amongst 500 stocks, like, look, I've got oil. Look, I've got retail. Look, I've got Berkshire Hathaway. Look, I've got tech. Over the last 10 to 15 years, the performance of the S&P 500 mirrored practically the NASDAQ because the FANG stocks and Berkshire Hathaway ended up being predominantly the drivers of the performance of the S&P 500. The S&P 500 is not diversified, people. It is a concentrated return of whatever's moving fastest in it. So if you think, right now, if for the next 10 years, oil is going to be the place to be, yeah, oil stocks may drive that, but it doesn't mean you're diversified if all of a sudden oil is not going to do well. Okay. And as we have seen, things change. So active management tends to do its best when you need it the most, when you're protecting what you have earned from paradigm shifts, from economic outcomes. We typically see recessions, Kirk, what is it, about every 3 to 5 or 5 to 7 years?
7 on average, historical average, but we're
7
well
on
beyond
average. So if you have longevity in your life, which is really important in terms of the assets you're saving, I'll go back to distribution. The longer you live, longer you have to have those assets last. That longevity means you're going to have a greater increase of getting at least one or two more cycles of tax rate impact, inflation impact, market impact, capital loss impact. All of those things hit harder the longer you live. And ultimately, you've got to be diversified and prepared. And it's when they're hitting that active management that cost you, that was destroying your wealth, right? That cost you're paying to get help is going to pay for itself in spades, because yeah, you might have saved yourself 1% a year over 5 to 7 years. But when the market drops 30 to 40% and you're not losing 30 to 40% because someone smarter than you, or the talking heads that are out there that say one thing is the magical button for everything, prevent that from happening, and you gave up some upside to make that happen, you are going to be better off in the long run. I assure you that Bill Gates has not been buying up just the S&P 500 fund. And although Warren Buffett says the average person should buy the S&P 500 fund, I'll tell you a little bit of a truth there, Kirk. I don't know if you know this. He's not. He's much more selective in what he buys. And by the way, he does sell occasionally when it makes sense.
Well,
So
if you
there's my
notice,
rant.
Doug, if you notice, the Warren Buffett's been sitting on cash for quite some time. He has something that is now actively dubbed the Warren Buffett indicator, which is basically market value, total market valuation compared to, I think, it's GDP or something along those lines. I'll have to pull it up. But the point is if you look at the ratio, it's well in excess of his historical norms. I think it went as high as like 220%. Normally, like 80 to 100% is cheap. 100 to 120 is expensive. We got to 220. That's how expensive the market was. But people are looking at the market and they're saying, hold on. The market is down 20 or 30%. Yeah. From an extremely overvaluated peak, we're still, what boggles my mind is we are still above the pre-COVID highs. Can you believe this? The market's down, but depending on the index, so I'm just going to use 20 to 30 because every index is different. Somewhere between 20 and 30% on the indexes. The NASDAQ is still above pre-COVID highs. Even though the NASDAQ has gotten beaten like a redheaded stepchild, it is still above that. Okay? Which means it was overvalued then. And people were getting out of the market in early 2020 because of overvaluation, not because of COVID, because things were expensive. And we're still above that. And I wouldn't say COVID did wonders for the economy. I would say it just basically pushed money from one place to another, but it didn't, maybe more in the pharma and less in, restaurants and airlines. But the point is, we didn't, yes, we had more money. I was just about to say we didn't have any more money, but we got a lot more money during that period. But the point is that it just sloshed the money around. It didn't all of a sudden make these companies better. It made some of them better and some worse, but overall, it didn't make it that much better than it was prior. So I think what you need to keep in mind is perspective. Now I'm going to share the screen once again. We have this chart of 2000 to 2013, and you can see this is the S&P 500. You can see this is 13 years of no growth. So we had bear markets, bull markets, bear markets, bull markets during that time. But effectively, in July of 2013, I think in the beginning of July, you would have lost like 0.5% a year annualized at that point. So for 13 years, you would have lost money. And it took that time to get back to break even. And if you think, well, that's an anomaly, the 70s look very similar. Oh, well, that's just the US. Oh, well, here's Japan. Look at Japan. 1990, it peaked right at the beginning of 1990. 23 years later, it's still going down. And it only in the last, 17, what is that? Yeah, in the last like almost 9 years, it's been going up. It still hasn't reached the peak.
Well, and
You're
Kirk, if
looking at
you're
a total
listening
of
to
30 years. Go
and
ahead,
if
Doug.
you're listening to the data that's out there and the reports on where Japan's going, it isn't going to reach the peak because it's this nice little run that it's been through. It's starting to crack and erode, and I have a feeling that you're gonna see this thing peter out before it gets back to it. The question is, will Japan ever hit its peak again?
Well, I think it depends on how you're looking at it because I think a big part of Japan is the currency. Japan's got lots of problems, and it's too deep to cover in the next 5 minutes. But yes, you're correct, Doug. I don't know that Japan will get there for a while. But Europe is also stagnated as well for some time. And I think what you have to keep in mind is that this is a very global economy is complex, but there are certain frameworks which are very simple. One of them is inflation. Inflation is fairly simple. We just haven't seen it in a while, so you don't remember how to act. You don't remember that you need to be thrifty with your money. You don't remember that you need to earn more than you spend, right? All of these things that people have gotten by with because quite frankly they could, right? Hey, I'll just pull more money out of my equity in my home to live. I'll do all these other things. Now, you actually have to save a buck. You have to pinch pennies. You have to do these things that people did in the 70s. Hopefully it doesn't get that bad, but who knows? Either way, we all have to do a better job at being financially responsible. And that's why we do this show every week, to help give you certain frameworks to help you understand how to invest better and how to think about whether it's investing or personal finance better. So, Doug, why don't you give us your last thoughts, and where can people find more about you, and then we'll wrap it up here.
Well, Kirk, we always have way more stuff we want to talk about than time, and thank goodness we can do another podcast, next week to hopefully get into some of those things, right?
Yeah.
So here's what I'm just going to use this transition again to talk with, since we're talking about inflation. Let's talk about the overall impact of inflation on the one thing that's dear to my heart, and that is college. Right? And everybody knows that one. That's been going on forever. It's become less and less affordable. Families are wildly concerned about the cost, but most importantly, families want a return on investment. They want, if you're going to spend this money, even if you can't afford it, you don't want your child to be going to college and then all of a sudden they come out of college and it's like, all right, now they're shopping a degree. They never get that degree. That degree does nothing for them. So basically, if you're going to make these choices on it and you're going to spend good money in college, make the right choices around academic, financial, and social. If what you thought you knew was true about the inflation of college, the impact of college, the cost of college, and you ultimately learned that it was untrue, when would you want to know? We have done a reoccurring webinar. We've got another one that's going to be coming up Thursday of next week, 6:30 p.m. If anybody wants the information on it, we'll make sure that we post that information to LinkedIn. But here's the main thing. Listen, if you have a child that's in high school, even middle school, you don't want to miss these presentations. It's critical information. It can transform your outcome from good to extraordinary. There is something we call the 3% Club. Only 3% of kids who have graduated can look back, that are in the workforce, can look back on their experience and say, hey, it was worth the money. And we had the experience and we had the support in college that really helped to transcend our future. The one thing that is true of those that are in the 3% Club, 2 to 4 times better engagement in college, 2 to 4 times better outcome in their future. If that's what you're sending them to college for, learn more now about how you can make that investment in your child's future come true, the 3% Club. And we'll put some more information about our webinar next week. My company is procollegeplanners.com, and you can learn more about that at procollegeplanners.com. Thank you.
Well, Doug, once again, thanks for joining us and sharing your wisdom with us. And Mikkel, thank you for joining us from wherever you are by the time this goes live. Always appreciate your wisdom as well. And thank you for the listeners for coming and joining us on this happy Friday on our LinkedIn Live. If you haven't come to one of our LinkedIn Lives, you should. They're typically 1 o'clock on Friday. If you're on LinkedIn, you'll get an invite. But yeah, so that's the show for this week. Thank you again for joining us in Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast in the podcast app of your choosing. You can also check out our show at moneytreepodcast.com. On our website, you'll have access to our show notes, resources, and the archive shows. Also, we're now on YouTube, so please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're not selling you any products or services, so don't consider this advice. If you have any problems with the show, I blame Putin. So please call him directly and express your feelings to him directly. If you're seeking financial advice, call an oracle or a fortune teller, or maybe talk to a licensed financial advisor. I'm one, but as I said, I'm not selling anything. But I'm easy to find. So have a great week ahead. And remember, no one will care about your money like you do. So invest in your life.